Hello, everyone, and welcome to episode 11 of the Lifespan Investment Series. Joining me again is Lifespan Investment Committee member, author, and publisher of the Payne Report, Jonathan Payne. Thanks for joining me, Jonathan.
Thank you, Eugene. Nice to see you.
Good to see you as always. So let's get into what's going on over in the US and global markets, which find themselves at a fairly critical juncture, one would think. 3 consecutive years of double-digit gains in the S&P 500 are really being tested at the moment, I think. With Trump's aggressive tariffs, and then you've got elevated valuations, which have been elevated for a while now, and obviously the strong possibility of the midterm elections, which tends to be a volatile period. What are your thoughts on that, JP?
Yes, Eugene. Yeah, that's quite a menu of interesting things to talk about. Look, the midterm elections, why don't we kick off there? Obviously, they're November. Yes, we are now beginning to start thinking about the midterm elections. If you believe the current polling, obviously the Republicans would lose the lower house, the House of Representatives. They might hang on to the Senate. And I think the numbers suggest they'd lose at least 15, maybe 20 seats in the House of Reps, which, obviously Trump and the Republican Party would not be happy about. But at the end of the day, Eugene, what the Trump administration is now trying to do is engineer a real takeoff in the US economy. And the numbers are actually beginning to look pretty impressive. We just had, strong second quarter growth last year, strong third quarter. We've got fourth quarter GDP this week. And the Atlanta Fed, the GDP now forecast is suggesting numbers are around and about the 4%, which would be astonishing because, of course, we had that very, very long government shutdown. But the bottom line, Eugene, is that the economic growth numbers are pretty robust. And don't forget, in calendar 2026, which we're now in, we've got the tailwind of the fiscal stimulus from the One Big Beautiful Bill, which Trump gave it that wonderful name. And then, of course, we've got the massive tailwind of this extraordinary increase in capital spending in, artificial intelligence, AI infrastructure, and data centers, which, due to the fact we just saw the hyperscalers recently upgrading their guidance for capital spending this year to an amazing sum of $650 billion. That is just from 4 hyperscalers. That is obviously Amazon, Meta, Google, and Microsoft. So my back of the envelope estimates are that if you add up the fiscal stimulus from the one big, that's around 0.9% contribution to GDP, coupled with about 1.6% contribution to GDP from the capital spending, you get a number of 2.5%. That's just AI capex and the One Big Beautiful Bill. And obviously we haven't started counting consumer spending yet. So if you then also look at the manufacturing surveys, we've seen some interesting improvement in the ISM PMI manufacturing survey, which for a very long time, Eugene, as you know, has been subpar, below that 50 diffusion index, that make or break number, which defines whether the economy, manufacturing, is expanding or we're now at over 52 for the manufacturing survey. And that's a pretty impressive number. So my best guesstimate for GDP this year for the United States is around 3%. And I'm beginning to believe there's a risk to that estimate, Eugene. It could be above that number, above 3%. So there's that. Now, the earnings season we're not quite fully through it, but we're nearly there. And the numbers are good. The EPS numbers are good. Yes, valuations are high, as you correctly point out. However, within pockets of the market, we've seen complete destruction. Look at the software names. The big software stocks have been annihilated because, of course, artificial intelligence is such a disruptive force. And every day now we see another sector in the US market or amongst US companies that are being disrupted by artificial intelligence. So it's all very, very fascinating. But you're absolutely right. The market now is beginning to focus and think about the midterms. Yes, valuations are quite stretched in some pockets of the market. And in broad terms, the S&P is, I think as we speak, is slightly negative on a year-to-date basis. The more attractive returns, as you know, Eugene, are elsewhere and overseas from the United States.
Yeah, it really is an interesting time. You touched on AI and the staggering amount of investment that we're going to see just with the big 4 companies that you mentioned. And if we think about who are going, because there is some talk about whether or not those companies are going to get a return on that capex expenditure, which is probably a longer, medium-term risk. But then, of course, who are going to be the major beneficiaries of AI? And we talk about the so-called picks and shovels type companies, your NVIDIAs and your TSMCs. Could you talk a little bit about the disruption, which you sort of already have, but perhaps with a little bit of a focus on some of the deflationary pressures and the continued dominance of the hyperscalers and those benefiting from the significant AI spend.
Yeah, absolutely, Eugene. You've hit the nail on the head. This is the debate in financial markets at the moment. We've just outlined that these 4 companies are going to spend a staggering amount of money, $650 billion on capital spending this calendar year. And we've also just highlighted you have the beneficiaries of that spending. So, the so-called picks and shovels companies. And my long-standing love affair with the magnificent one, which of course is NVIDIA. And by the way, if I may just say this briefly, Eugene, happy birthday, Jensen Huang. It's Jensen Huang's birthday today. One of the greatest entrepreneurs and innovators of any generation, remarkable individual. And I could go on and on about his life history, which is a truly remarkable one. But anyway, he's a game changer. He's one of those individuals that will shape and define the technological landscape. And as you know, Eugene, you and I have had many, 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 many conversations about the technological transformation that we're all living in right now. Everyone listening to this needs to understand that AI is going to change all our lives. This is one of those hinge points, those inflection points, one of those crossroads in history. And AI will shape and define the technological, economic, and even socioeconomic landscape in the years ahead. My new favorite expression, if I can just share it with everyone, Eugene, my new favorite expression, and I'm saying this to everyone I meet, even the lady that I go and visit in the post office in my little remote village. And I've said this to her: artificial intelligence will make exceptional people even more exceptional. And it will make truly exceptional people even more truly exceptional. The way I think about artificial intelligence is right now, as I'm speaking to you, Eugene, right now, I'm surrounded by a room full of PhDs. In fact, I would even say perhaps I'm even surrounded by Albert Einsteins. So the fact of the matter is AI enables someone like me to have a meaningful, deep conversation with the best experts in the world in whatever topic or theme that I'd like to discuss with them. And this is transformative, but it's also highly disruptive. I wrote my recent report was entitled The Mother of All Disruptions. I gave my first speech of the year yesterday, and it was entitled The Mother of All Disruptions. And so we need to get our head around this. There's going to be winners. There are going to be losers. The market is grappling, as you correctly highlight, with this question: what is the return on invested capital for the so-called hyperscalers? Those are the big 4 names: Amazon, Google, Meta, and Microsoft. Because when you spend that amount of money, surely the question should be, when are you going to get a return on that investment? And now what these companies are effectively doing, Eugene, they are building a giant brain. Think of AI as a brain which every person on the planet has access to. It's crazy when you think about it. Like, there's over 8 billion people in the world. Wherever you are in the world, you could be in the remote village in Africa or the Amazon, as long as you've got Elon Musk's Starlink, you can have access to a room full of Albert Einsteins, or at least a room full of PhDs. It's phenomenal. And the risk is, of course, of the displacement in the jobs market. But the bottom line is these massive hyperscalers are investing in creating this giant brain, which everyone, wherever they are, right now on my screen, right next to me where I'm speaking, number of models. And by the way, always update to the latest model. And so these massive companies are investing vast amounts of money because they believe in the future of artificial intelligence and, moreover, the potential monetization of their investment in AI. How and why? Because, of course, we're now migrating from you and me just simply typing a question into ChatGPT, when is Cindy Crawford going to have dinner with me next? That's the kind of you and I stuff. The companies, institutions, the military, enterprises around the world are now basically employing agentic tools. And just in the last couple of weeks, we've seen some extraordinary breakthroughs and innovations from Anthropic, which is one of the models. And these companies, all enterprises, every enterprise is going to have to implement and employ AI in their workflows, in their processes, and in their businesses. And that basically leads to, effectively, these massive companies that have built this brain renting out capacity and access to this giant brain to enterprises all around the world. So I'm a believer, have been for a long time, and we're just beginning to see the first real traction where enterprises are now saying, wow, we've just really figured out the power of these large language models. Now, the beneficiaries, and have been for some time, of course, NVIDIA. They are the heart and soul of the AI revolution. NVIDIA, of course, designs the GPUs, the fastest GPUs and chips in the world. But the actual manufacturing of the NVIDIA Blackwells, and we're going into Rubin soon as well, the fastest processors in the world are obviously, they're made by TSMC, which makes 90% of the world's production or supply of the world's most efficient and fastest chips. And as we know, and you and I have spoken about this for a long time, how important TSMC is to the world. I've called NVIDIA the magnificent one. Well, TSMC is the indispensable one. And we know, what is Trump doing? He's got TSMC to invest huge amounts of money in building manufacturing capacity in the United States, principally in Arizona, which is really interesting. But basically, you need to have exposure to the companies that are actually making and designing the wiring and the hardware of this new super brain. NVIDIA, TSMC. And then you can look at a Google, which is building the so-called TPU, which is a rival to the NVIDIA GPU. And Google, of course, has a massive footprint, and they can monetize through Gemini and search and ads on their massive Google platform. So it's a fascinating time to be in the financial markets. I understand the anxiety of investors. There's still people who don't really either A, understand or believe the transformative technological phenomenon that is now in our lives. And there are question marks about unemployment. There are very, very difficult conversations to be had about the joblessness amongst graduates leaving university. These are really, really important issues. But the bottom line is this volatility in markets is the market beginning to think and price whether this AI phenomenon is durable and real.
Yeah, it's going to be an interesting year or two, and I think development's going to be exponential and really accelerate. We're going to see some big, drastic changes. And there's people out there saying all kinds of interesting things about the volume of particularly white collar jobs that are going to go and businesses that are going to go, might add. And also, I think Elon Musk came out and said something like, don't worry about saving for your retirement. AI is going to make everything so productive that everybody's just going to, life's just going to be really easy and you won't need that much money in retirement. So I certainly wouldn't advocate that you do that, by the way, for anyone. But who am I to contradict Elon Musk, I suppose. Anyway, let's move. Actually, before we move closer to home, comment I want to make for you to comment on. So it is very volatile. We've seen a big sell-off in tech stocks, but the indexes are still pretty close to their highs. So obviously there's winners and losers, and it seems to be kind of net offsetting. The winners are sort of offsetting the losers a little bit. Do you expect that to continue, or are you concerned about a broad sort of sell-off?
What we've seen is
12 months.
Yeah, it's such a fascinating market. We've got this massive churn beneath the headline, and the S&P 500 is a bit like a swan swimming across a very, very, very calm lake. But underneath the surface, its webbed feet are, propelling it forward. But if you look at it above the water, everything seems calm. Beneath the water, there's this activity of its webbed feet. The S&P is pretty much unchanged for the year, might be slightly negative. But within that, you've got, for example, which is good for us, smaller companies have significantly outperformed large caps on a year-to-date basis. In fact, over the last more than a year-to-date, over the last 3 or 4 months. So you've got this broadening in the overall market, and names like Microsoft, were down at its recent low from their late October, early November peak. They were down over 20, 23, 24%. Microsoft. And then you've got other names. Amazon hasn't performed well over the last 3 months and on a year-to-date basis. And these are the hyperscalers that are being penalized by the market. They're saying, show me the money. The market's saying to these hyperscalers, show me the money. Show me the return on invested capital. Google, however, has been a very strong performer on a 3-month basis. So, it's kind of interesting. There's a dispersion and a discrimination taking place. For much of 23, 24, coming into 25, the so-called Mag 7 all rose together in a uniform manner. Now we've got dispersion within the Mag 7, and we've got much dispersion across the top 500 companies in the so-called S&P 500. Beneath that, smaller companies are doing well. Why? Because we've got a strengthening in the economy. We've got deregulation, which small companies love. We've got actually fairly strong bank lending. The bank credit numbers are quite robust. And we've also got the advent of the One Big Beautiful Bill. So the earnings profile for smaller companies looks very robust. So those are some of the reasons, Eugene, we had these conversations last year and said we thought smaller companies would perform well, which they have. But that's come at the expense of some of the really big names like Microsoft, as I said, which have really underperformed the market. So it's going to be very, very choppy. Financials have been interesting. Transportation stocks got smashed last week. We got fund management names getting smashed last week, all a consequence of the potential disruptive force of these so-called agentic AI tools.
Yeah, okay. So we've got a range of different factors, positive and negative. Obviously, those growth numbers, and let's not forget the new Fed chair coming in.
Yes,
in a few months, who's going to be very dovish. I think, although I would imagine a lot of that's probably priced in because that's been expected for a while. So we could go on and on and on, but I guess it's going to be a really interesting few months. There is quite a bit to talk about when it comes to the Australian market and the economy. Obviously, we had a rate increase in February to 3.85% from 3.6%, the first in a couple of years, obviously driven by ongoing inflation concerns. What do you think, JP, in terms of the prospect for future rate hikes? I think that rate hike was widely anticipated, but if you go back 6 months or perhaps even less than that, nobody was predicting rate rises. In fact, people were expecting another rate cut. So it goes to show how quickly the sentiment can change with a couple of hot inflation numbers. What are your thoughts, mate?
Yeah, absolutely. You're absolutely right, Eugene. 6 months ago, 9 months ago, no one was talking about a rate hike in 2026. It's the kind of the worst possible news pretty much for everyone. The RBA themselves were very shocked by the increase in inflation in the second half of 2025. That left the RBA with no option but to increase interest rates. The prevailing inflation rate levels are so much higher than their targeted band between 2 and 3. And moreover, the RBA themselves said, look, it's not going to get back to target for some time into the future. Obviously, the Australian Labor government is not exactly amused by this change in monetary reality. But at the end of the day, the Labor government has been, spending. And I seem to recall at the last election, there was this commitment that electricity prices wouldn't go up if you vote Labor. I seem to recall that the electricity prices, if my electricity bills are evidence of fact, they have gone up dramatically in the last 12 months, last 18 months. But there you are. So, and electricity was one of the big factors driving up inflation here in Australia. And Michelle Bullock at the Reserve Bank, and I listened to her press conference when she announced the rate increase, you could actually see the kind of stress and disappointment on her face. And I personally think that if she can get away with not having to raise rates again, she would prefer not to raise rates. But if these inflation numbers, they're very sticky here. They're very sticky. We've got very strong state spending, fiscal state spending. You've got federal spending, electricity prices. I mean, and who knows? Look, we've got a challenge here in Australia. We've got factories in Australia that can hardly afford to turn the lights on. Let's be brutal and honest, because our electricity costs are just through the roof. And if you compare them with China, you go into a complete state of depression. So the bottom line is we've got a pretty unpleasant kind of economic mix. Productivity doesn't even have a pulse rate here in Australia. In the United States, in contrast, productivity is very, very, very robust. In fact, I believe we're going to see continued improvements in productivity in the United States. In fact, if you did a contrast between the US combination of growth and productivity and relatively stable and low inflation, and you made a contrast with Australia, you'd go, oh boy. So yeah, I look, the Reserve Bank may well raise rates again. I'll have to have another really good look at the inflation numbers. Whenever I do look at them, it's sticky as hell, Eugene. I'm not going to pretend that inflation is going to suddenly dissipate. And I think a lot of it will be driven by what happens to electricity prices. And it just seems that we've got a real problem in Australia with, seriously high in electricity prices.
And housing too, I suppose.
Housing, absolutely. Housing
it never gets any easier.
No.
All right. And then in terms of the Aussie share market, do you think we're in for a rough ride in Aussie markets this year? I could see the S&P 200 pretty much around its all-time high, along with most other major broad indexes, developed broad indexes. It's up a couple of percent for the year. What are your thoughts on that?
Yeah, it's an interesting one, isn't it? I mean, the ASX 200, I think, is around plus 2% year to date. I mean, just contrast that with emerging markets, which are up 11% year to date. And if you take it from their kind of July, August, September levels, they're up much, 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 much more than that. So if you just did a contrast of emerging markets versus the Australian market, I mean, emerging markets has blown the lights out in comparison. CBA had that plunge from $192 in July last year, went all the way down. It went, I think it got as low as around $147. And they produced some better numbers the other day, and they seem to have had a little bit of a renaissance.
Yeah.
But and that's helped lift the broader index. BHP's been doing pretty well. BHP's probably the pick of the bunch from an earnings potential. They've got a lot of copper, and copper's really exciting. So I'm not going to get overexcited about prospects for the Australian stock market. I believe emerging markets wins hands down when it comes to fundamentals. I noted that Goldman Sachs revised up the estimates for emerging markets in calendar 26. They already had a really strong forecast. I think they're now looking at earnings growth across emerging markets of 17 to 18% in calendar 26. The Australian corporate world can only dream of earnings figures such as that. So, in relative fundamental terms, you'd have to favour on every single metric the emerging markets over Australia.
Yeah, okay, cool. And now that you've touched on emerging markets, where do you think the biggest opportunities in EM are in 2026?
Yeah, I'm still excited about India. I know we had a pretty flat 25. We've had a difficult start to 2026 because some of the big software names in India have got disrupted or hurt by, obviously, the generalized decline in the software stocks, Salesforce and others in the United States. So some of the big software names in India, Infosys is one of them, has taken a bit of a hiding, but the financials in India are still very strong. You've got very strong fundamental growth for the banking sector and financials at large. The good news, the list of good news factors for India is a very, very compelling one. You've got rising middle class. You've got rising incomes commensurate with the expansion in the middle class. You've got this huge domestic market. You've got, deregulation. You've got, over time, an improvement in infrastructure, which is one of the big stories about India. They are making some progress in infrastructure. But all in all, you've just got this massive economic potential and very, very, very robust earnings profile for Indian companies. So India still has to be one of my picks. But Eugene, I've never been bearish on India, so I have to disclose that. I've been bullish on India for 15 years, ever since I went to the Taj Mahal. So that was a very, very long time ago. So then you've got some interesting dimensions in the emerging, in the so-called, not the so-called, but in the exchange traded fund, the EEM, the ticker code. And obviously you've got big names in there, TSMC's in there, and some of the South Korean names. I still think it's crazy, to be frank, that South Korea is classified as an emerging market. I mean, South Korea is more advanced than a lot of countries in the developed world. In fact, as I've said to you, Eugene, and to the rest of your team on the investment committee for some time, I have got a letter into MISCI. My proposal is to put the United Kingdom and France into a new submerging category and to revise the definition of emerging. I would put South Korea and countries like that way ahead of the United Kingdom and France. So that talks to actually the new fiscal reality. Eugene, all the time we've been in this industry, all we've seen is advanced so-called developed countries lecturing so-called developing emerging economies, to be more frugal when it comes to fiscal policy, to control their debt and their budget deficits. For decades and decades, that's all we've ever heard, so-called advanced countries say. Well, hello, today, emerging markets should be standing up at every international forum and wagging their finger at so-called developed countries like France and the UK, saying, get your fiscal house in order. The fiscal arithmetic has been turned upside down. Much of the emerging markets now have much better fiscal arithmetic than their counterparts in the developed world. And that changes what we call the fiscal risk premium, and is another factor why emerging markets are attractive. And the other one is, Eugene, and I think the big global investment institutions are beginning to absorb this new political reality that much of the emerging world is more stable than the developed world. Again, we can put our finger on France and the UK, and you might even, or some others might even suggest, we've got a little bit of disruption in the civil and social corridors in the United States. So yeah, the emerging market thesis, the fundamentals, I think, are intact, Eugene.
Okay. All right. So definitely some opportunity over there, and from a valuation perspective, and from an earnings growth perspective, far more attractive. But obviously, it comes with its risks. All right. Let's touch quickly on gold, and then if you feel like it, and I know you do because I enjoy reading about what you write, if we could talk a little bit about silver and copper. Obviously, we've seen a hell of a ride to start the calendar year in the gold, silver, and copper markets. And gold has kind of stabilized a little bit. But it is almost 10% or so off its high, but that high was very, very short-lived. Talk us through it briefly for those that maybe haven't been paying attention to gold. For those of you who've put gold in the portfolio, obviously it's done very, very well. Jonathan, you've been talking up gold for a few years now. You're certainly not a gold bug, but you've been encouraging people to invest in gold for at least, I think, 2 or 3 years back when gold was at about just under $2,000 US an ounce. It's now at $5,000, peaked at $5,500. Yeah.
Okay, well, I'll kick off with gold. I don't know how many of the people watching this get my weekly pain report, but it's been quite a journey, Eugene, over the last several years. The fundamental investment case or thesis, which underwrote my very positive view on gold, was that gold was in my view, the ultimate insurance policy, and particularly insurance policy against geopolitical anxiety and developments, and particularly post the Russian invasion of Ukraine on February the 24th, 2022, and the rise of what I've described as the so-called axis of autocracy, Russia, China, Iran, North Korea. And since that time, China, to give you one example, significantly increased its exposure to gold. And other countries such as Poland, which, as you know, sits in a very interesting part of the world. And if you study Polish history, you'll understand why the Poles are very anxious about, the geopolitical temperature that's prevailing in the world today. I mean, there's very few countries in the world that have been invaded by so many people as Poland. So the Polish central bank has been one of the largest, if not the largest, buyer of gold in the last 2 to 3 years. And a number of years back, I wrote extensively to my subscribers, keep an eye on these central banks. The other one was actually Turkey. And so I kept saying, look, central banks around the world are beginning to diversify their foreign exchange reserves, and their safe haven asset of choice is gold. And then that obviously has, built up a tremendous momentum. And that was the kind of starting point. And then institutions started going, hang on a minute. Wow, when we put gold in an overall portfolio, it's got wonderful diversification benefits. So we started seeing all these white papers published by fund managers, some of them not that long ago, saying there's a huge diversification benefit. It doesn't correlate to other assets. It diversifies and spreads your risk in a broadly diversified portfolio. And so you started seeing institutional interest. But what we know today, and I used to say 3 years ago, that institutions around the world have approximately 0.7% of their total assets invested in gold. And I said, just imagine if it goes to 1, and then, wow, what if it goes to 2, and then don't even think about it going to 5%, because the actual amount of money that would represent, you wouldn't have enough gold in the world. And so obviously, since that time 3 years ago, it's kind of gone to 0.9 of 1%. It might be now just over 1%. In the meantime, the central banks have been accumulating gold. So the fundamental thesis, I think, is still intact, because we have this new geopolitical reality. And I think the Russian invasion of Ukraine kind of amplified, accelerated that new geopolitical reality. So the fundamental case and argument for gold is there, and institutions are interested in putting gold into client portfolios. Silver, I've got to talk briefly about silver. I really shocked myself. On December the 15th last year, my final weekly pain report for the year, I decided to be courageous and create and build a so-called model portfolio. Now, my readership ranges from, institutions, hedge funds, high net worth, blah, 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 blah. And how do you build a model portfolio for everyone? It's really tough. But a couple of high net worth people said, listen, come on, JP, put your money where your mouth is. What's your perfect model portfolio? So I built one in December. And I surprised myself. I put in silver because, Eugene, I'm terrified of silver because, some of my readers are very aggressive, high net worth traders. And if I put silver in there, they'll go out and buy silver and the thing will either go up 30% or fall 30%. So I don't like putting silver into a broad portfolio, but I did. And then, of course, silver misbehaved itself. From December the 15th last year to January the 29th of this year, silver rose 92%. 92% in 6 weeks. So I immediately punished it and removed it from the portfolio. And I put that out to my subscribers. I said, get out of silver. It's gone mad. It's gone up too much too fast, 92, whatever. And so silver's no longer there. Now, silver crosses over from a kind of precious to an industrial metal. Silver's used, obviously, in solar and also in electronics. There's basically a shortage of silver relative to demand over the next 2 to 3 years, running into a big silver deficit, supply-demand deficit. So the fundamentals are pretty robust. But, this thing was trading $25, $30, 18 months ago. And it went to 100 and whatever it did, $112 an ounce. So anyway, I took it out of the model portfolio. So all bets are off on silver. And I don't think I'll go back to recommending silver. Copper, the supply-demand picture for copper is unambiguously positive, Eugene. One of my big themes of the last couple of years is the electrification of everything. And electrification and the ability of economies to generate ample and plentiful and cheap electricity will be the primary determinant of their economic success. Now, if you continue with that theme and then you bring in data centers and the amount of copper that's going into these massive, giant Goliath data centers, and we also know that China would buy every ounce of copper available in the world if they were able to or allowed to. And I think governments, countries, and companies are going to be stockpiling copper because we're running into a major deficit. The demand for copper looking forward exceeds supply. And usually it takes a long time to bring a copper mine online. Yeah, right. Yes, there's quite a lot of copper around, but I tell you what, to try and ramp up production to meet the potential demand for copper in the next couple of years, you'd really seriously have to ramp production. It's just not going to happen. So copper prices will continue to go up. And if my thesis about electrification is right, and I think it is, then there's going to be insatiable demand for copper. And the other reality check is that China has an electrical capacity, or the amount of electricity that China generates is many multiples of the United States of America. And in the last, from 2010 to 2024, the increase in the electrical capacity of China, the amount of electricity they can generate, was more than the rest of the world combined. And so China knows to win the economic race, they've got to generate a lot of electricity and generate it at an affordable price. I wish someone in Canberra actually understood that. Germany, tragically, has electricity prices that are about 5 times Chinese electricity prices. And as a result, major German manufacturing companies are shutting up shop and leaving Germany.
Yeah, right.
So that's the new energy reality.
Fair enough. So silver's, they're all very volatile, can be very volatile.
Yes.
Basically, silver's had an incredibly volatile period and you're not touching that anymore. You've explained, I think, the supply and demand situation with copper well, so that's an interesting one. And of course, gold, well, that's been a much longer term story. So very interesting, but I guess I would caution everybody just to be careful because they are very volatile commodities. All right, let's quickly touch on bonds. So long-term bond yields, could you talk about that a bit, JP, and their impact on asset prices and the potential repatriation of foreign assets, an example of that being Japan?
Yeah. Well, talking about Japan, we saw a stunning election victory by the LDP, Liberal Democratic Party in Japan, fueled by the euphoria for the new prime minister in Japan, Takaichi. And she really is a really forceful personality. It's a very interesting background, and I won't bore everyone with the Takaichi story. But suffice to say that the LDP, the government of Japan, has just secured the largest supermajority. They have more than 2/3 of the members of the lower house in Japan. It's the largest majority of any political party since the Second World War. And she now has a mandate And basically, Japanese equity markets generally quite like large mandates. We saw it before in previous times. But what that also means is that she has a mandate to kind of pump prime, increase the fiscal stimulus for the Japanese economy. She's actually been very explicit about that. So, for example, looks like they're going to reduce the sales tax as an example. And she's trying to bring down prices and inflation in Japan. So what you've seen, of course, in advance of the recent election, which was only last weekend, not the weekend just gone, the weekend before, we saw Japanese government bond yields rising very, very sharply. They've come off a little bit since that time. But in the last 2 to 3 years, Eugene, Japanese government bond yields have gone through the roof.
Yeah.
It is truly remarkable. So I think there's probably still upward pressure on long-term Japanese government bond yields. Here in Australia, we've seen upward pressure on the long end, although in recent weeks it seems to have calmed down just a little bit. So the 10-year today, I'm looking at my screen, the 10-year in Australia today is 4.71. I think that got as high as 4.88 a couple of weeks ago. So there has been some upward pressure on Australian government bond yields. But if you look at a 5-year chart, Australian government bond yields have really pretty much gone sideways over the last 3 or 4 years. 3 years, more than not so much 5 years, 3 years. And then when you look at the United States, now that really fascinates me. You know that I can be as boring as the most boring person on planet Earth. And I've tried to temper my conversation around basis points in my weekly pain report. Some of my favorite subscribers, and I do have favorites, would write to me and say, can you stop going on and on and on about fixed income markets? It's really bloody boring. And so I took their advice. And it was really good timing for me to stop talking about bonds, because actually, if you look at US long-dated, and I know you know this, and I'm sure all the listeners will know this, long-dated US Treasury government bond yields have done absolutely nothing for like 6, 7, 8, 9, 10, 12 months. They're almost unchanged. And in fact, in recent weeks, the 10-year in the United States we're moving back towards 4%. But we've traded in a relatively narrow range now for a very, very long time. So it's really boring. Yes, bonds are boring again. I hate to say that as someone who started in the bond markets in 1984 in London. And then you've got upward pressure, a bit of upward pressure in the United Kingdom. There's some special factors at work there. We know the Lord Mandelson story and the prospect or possibility that Sir Keir Starmer, the Prime Minister, gets pushed aside by Angela Rayner. We'll see. That's another conversation. But the bottom line is bonds have been relatively dull in much of the world, particularly in the United States, which is probably a good thing.
Yeah.
Whereas in Japan and Australia, there's been an upward bias to them.
Yeah, you want bonds to be dull, I suppose.
Right.
In a sense. And we're going to talk about the portfolios briefly after this, but we've kind of been underweight duration, which has been good because we have seen either a flat line in long-term bond yields or an increase, as we've seen in Australia. But is it, at high fours over for 10 years, is that starting to look a little bit attractive?
Yeah, we haven't really probably touched sufficiently in this conversation today on the massive potential productivity benefits of artificial intelligence. And once you start that exploration or conversation around productivity benefits from artificial intelligence, it takes you immediately into the exploration or the outlook for inflation. And AI, big picture, AI to me is unambiguously a deflationary force. A deflationary force. Now, we're talking over the next 2, 3, 5 years. Now, we don't know how quickly we'll see enterprises adopt and implement and incorporate AI, but I think it's just happening, and it's happening all around me whenever I talk to people.
Yeah.
And that will have long-term productivity benefits and therefore, I believe, be a disinflationary, if not deflationary force. So maybe the long end of the US market, the long end, because the 10s, as I just said, they're trending back towards 4%. It's really interesting. I mean, that conversation I know is taking place in the US about this kind of productivity benefit and dividend from AI. That takes us into that disinflationary impulse. And maybe that's why the long end of the US is moving down a little bit. So it's a hard one to play, but the big picture for me, the big medium-term picture for inflation is one of disinflation, if not deflation. Now, I'm not ready yet to kind of go overboard about my 5-year view being deflationary. I'm not ready. I'm not intellectually ready to jump into that pond. But if you look at China, the deflationary forces are there. And amazingly, Eugene, I never thought these words would come out of my mouth because India's always been a high inflation country. We're getting relatively low inflation in India, which is, I think, very interesting. And I know Japan is having this inflationary experience, but a lot of that is driven by the weakness in their currency. The Japanese yen has been horrendously weak against everything. And a lot of that, because they import a lot of raw materials, they import a lot of energy products, and that is fed through into high prices in Japan. I think we can almost put Japan on one side for the moment. The big picture, 3 to 5 year view, is there are the disinflationary shocks, I believe, will be greater than the inflationary shocks.
Okay. Well, that'll be interesting to see. And as I think we both agree on, this is all going to change very quickly over time. So, which makes it hard to sort of lock in a yield for 5 or 10 years because you just don't know what it's going to look like. All right, let's move to the portfolio. So not a lot to say here because we haven't made any changes since the last episode. So where we did some restructuring in fixed income. So I mean, and the reason we haven't made any changes, I think we're reasonably well positioned for how things are and how things are evolving, which is to be diversified. We prefer high quality stocks and bonds because in these uncertain times, that's probably what you want. You do pay for them sometimes in terms of stocks valuations can be a bit higher with quality stocks, but if there is fallout, you would expect them to be able to work through and come out the other end okay. So we like that. We've got some emerging markets in there. We've got lots of mid and small caps overseas. We've also got a lot of mid and small caps in our Australian stocks, which gives us broader exposure and again more diversification. When there's a lot of risks out there, but equally, I mean, we talked about growth numbers in the US. If we were to see GDP growth of 4% plus, gee, that'd be something. They're big numbers for a big developed economy, not coming out of a COVID or a deep recession. So that would be something. And then of course you've got AI, which will be a disruptor, but it'll also be a massive opportunity. Think about what AI could do for profit margins. For example, right? Yeah. So anyway, diversification is important for us. We're overweight real assets because we think that's an area that gives you obviously some diversification from equity markets, but also it's likely to be a beneficiary of the AI market through infrastructure, data centers, and other means. And then again on the fixed income side, we've as we spoke about last time, we've moved into a fund that's a bit more active and that will take opportunistically positions in high yield. But most of our fixed income exposure is high quality assets because again we think that's where to be. And mostly we have an overweight position to floating so that we don't have interest rate risk as much interest rate risk over the long term. So that's kind of a snapshot of where we are on the tactical portfolios. We did drip feed a little bit more broadly across the various growth assets, not all of them, but a broad sample of them. But we still remain a little bit underweight growth, both in strategic and in tactical. But we're getting much closer to neutral, and we've got a big enough weighting so that if markets do continue to run, we'll do pretty well. And the portfolios are performing well. So. And you've heard Jonathan talk a little bit about some of the asset classes that you like, emerging markets and just small caps globally. And of course, we've talked about fixed income. So our portfolios are positioned well for a lot of these themes. Jonathan, anything you wanted to add on that?
Not really. No, that's a really good summation. And as you say, it's been nice. We made that allocation into emerging markets or increased it some time ago, and also smaller companies. It's nice to see both those coming through. So it's been an interesting 3 months since you and I, we've spoken many times in between, but since we were both on camera together, and you and your resplendent, wonderful, bright white shirt, Eugene, you look extremely fresh and youthful today. You're making me feel very old, but I think you summed it up perfectly.
Thank you, Jonathan. You're too kind. Well, look, and on that note, I think we'll close for this session. Thank you for joining us, everybody. Thanks again, Jonathan, for joining us as usual. Great to hear your thoughts. If any of you have any questions, please don't hesitate to reach out to your financial advisor. And if you don't have one, contact us and we'll find you one. Thanks again and all the best.